What is the Fed trying to say with the timing of its decision to increase the discount rate? Well, joining me with answers is Randy Kroszner. He's a former Fed governor himself. He was there at the height of the financial crisis and left the central bank just about a year ago. He's now a partner at Potomac Partners, and he joins us this morning from Chicago. Sir, the timing here has really drawn attention. We knew that the discount rate was the mechanism to watch. That was well telegraphed by the Fed chairman himself. Tell me how to interpret this. Some say it's the shot across the bow warning us that interest rates and all the rest of the mechanisms are about to be put into play. How do we interpret this?
I would really take the Fed much more at its own word that this is more of a technical adjustment rather than something that is going to lead to an immediate policy change. I think one of the reasons why they chose to announce this not at a regular FOMC meeting, but after the minutes came out, when they had warned that they were soon going to make this change, is precisely because they didn't want it to be seen as a change in monetary policy. When decisions like this are made at the FOMC meeting, people often think of it as something about monetary policy. I think they clearly wanted to differentiate that, and that's what accounts for the timing.
Mm-hmm. So more of a cosmetic change here from your point of view than truly a change in the read on the economic climate?
Yeah, I think it reflects the greater stability that we've seen in the financial markets, that the Federal Reserve, just as it's been running down all of the different liquidity facilities that we enacted while I was there, they want the banks to turn to the markets rather than turn to the Fed for liquidity. Mm-hmm. By now raising the discount rate a little bit, that'll give more incentive for banks to turn to market actors rather than the Fed for liquidity provision. I think it's really kind of part of that same gradual transition that's been occurring over the last 6-9 months.
Well, perhaps we're jumping the gun here, but you know the speculation bubbles up when you see any kind of move. The question is, when are interest rates going to be on the move? Any move this year, from your point of view?
Well, they've been very clear to keep the extended period language in and not adjust that. Obviously, we'll be getting testimony from the chairman next week, and that'll be important to see if there are any changes in nuance or changes in words. But I don't predict that. I think it's really going to depend on how the economy evolves, and I think towards the end of this year, beginning of next year, we could start to see some moves, and that's pretty much what the futures markets are expecting.
Mm-hmm. And you're in good company. I know PIMCO's Bill Gross was out this morning saying as well he doesn't expect a move in interest rates, but he was also saying that investors expect that yield curve to just continue to steepen. I mean, take a step back. Give me a sense of some of the indications that you're watching that make you feel that the fundamentals of the economy are improving and strong.
Well, I think one of the key things that we've seen is continued high productivity growth throughout the entire crisis, and in particular over the last 2 quarters. We've seen astonishingly high growth of output per hour, like 6 or 7% growth rates. That suggests to me that the fundamental engine of growth in the economy is not broken, and that as things stabilize, we can start to see recovery. We're seeing good profits. The unemployment rate, unfortunately, is high and is probably going to stay high for quite some time, but I think we'll be starting to see the conditions of stabilization that'll then bring us back, and the engine is not broken.
Wasn't Europe supposed to move on rates before the U.S.? I mean, that was sort of the conclusion the market seemed to have reached. Tell me, what has changed out there? Give me your global view here on the situation with the fiscal crisis in Europe and what spillovers we might need to be tracking.
Sure. Well, just in general, when a shock hits the U.S. versus Europe, the U.S. may go down a little bit more sharply, but it tends to recover more sharply. In Europe, because there are so many inefficiencies in their regulations, whether it's in the labor market and elsewhere, it's much more difficult for them to come back. And so I think this crisis just adds to that, and you're going to see slower recovery.
All right. Thank you so much for all of your analysis. Former Fed Governor Randy Kroszner joining us from Chicago this morning.